One of the reasons that we still use this language is it's so helpful to understand the liability between the limited partner who has limited liability and the general partner that basically has general liability.
Hi, everybody. Once again, David and Drew with Nighthawk Equity here. In order to understand what a real estate syndication is, you have to know the difference between a general partner and a limited partner. Drew, what are some key differences between these two things that investors must know?
Sure. Thanks, David. So general partners are the people that put the deal together. They're also called the syndicators of a deal, right? They go out, they find the deal, they underwrite the deal, they go on site and make sure it looks good, and they sort of put everything together. So they manage the asset and they hold really essentially all of the control. Limited partners get to benefit from the general partners, get to sort of ride their coattails, and they do not have to put in their time and their energy into overseeing the asset. The name limited partner revolves around the limited liability that they have. LPs have significantly less or no liability in these investments. It's important to note that these names historically come from when investments in apartment buildings were done in the legal structure of partnerships. Nowadays, we do them inside LLCs. And so legally, technically, they're not LPs and GPs, but we speak of it that way just to delineate the people that are on the operating side or the GP side, or on the passive side, the LP side.
Now, let's talk a little bit more about the liabilities between the LPs and the GPs. What are the key differences between the amount of liabilities possessed by the general partners as opposed to the limited partners?
Right. Yeah, David, one of the reasons that we still use this language is it's so helpful to understand the liability between the limited partner who has limited liability and the general partner that basically has general liability. So the LP's liability is usually limited to what they've invested. So if you put $100,000 into a deal, the worst that can happen to you is you lose that $100,000. Now that's unlikely, but it could happen, right? Whereas the GPs, as the people that put the deal together, take on even more risk in order to give the benefit of the investment to the LPs. So the GPs will sometimes personally guarantee the debt on the asset. So you buy a $10 million apartment building, there's $8 million of debt on it. That mortgage, that debt, the GPs are personally responsible for at times if the investment itself doesn't go well. So the GPs take on significantly more liability in order to give the investment opportunity to the LPs. So again, in that worst case scenario, the LPs, they lose their investment, but the GPs have, in a sense, unlimited exposure on that deal.
Well said, Drew. Thanks for the information. Now, if you're watching this and you're interested in learning more about important terms like this, or if you're just interested in investing passively with Nighthawk, please book a call with me. You can do that by visiting the following link. It's nighthawkequity.com/call. Look forward to speaking with you, and thanks for coming on.